Today we are taking a close look at Axos Financial Incorporated, ticker symbol AX on the New York Stock Exchange. Axos is a publicly traded bank holding company headquartered in Las Vegas, Nevada, with a market capitalization of approximately $5.6 billion at the current price of $98.51 per share. Our analysis covers the company's fundamentals across 8 key dimensions: its history and business model, profitability, growth, interest rate risk, credit risk, capital and liquidity, valuation, and our overall conclusion. All data is sourced from Axos's most recent public SEC filings, including the fiscal year 2025 10-K, the second quarter fiscal 2026 10-Q for the period ending December 31st, 2025, and the January 29th, 2026 earnings release. Axos Financial was founded in the year 2000 as Bank of Internet Federal Bank, one of the very first internet-only banks in the United States. In 2018, the company rebranded to Axos Financial to better reflect its expanded business lines. Its principal operating subsidiary is Axos Bank, a federally chartered savings bank. The company also operates Axos Clearing LLC, a full-service broker-dealer clearing and custody business. Axos is a branchless nationwide digital bank. It has no physical branch network, which is a key differentiator and a source of its cost advantage. The bank operates across the entire United States, gathering deposits and making loans digitally. It serves a number of interesting niche markets. It serves approximately 30% of all U.S. Chapter 7 bankruptcy trustees under exclusive relationships. It provides banking to 1031 exchange firms, homeowners associations, title and escrow companies, and it provides broker-dealer reserve account and client cash management services through Axos Clearing. As of December 31st, 2025, Axos had $28.2 billion in total assets, $24.3 billion in net loans, and $23.2 billion in total deposits. Stockholders' equity stood at $2.93 billion, or $51.70 per share in book value. A significant recent event was the acquisition of Verdant Commercial Capital, an equipment leasing company. This acquisition is still being integrated, and it added approximately $18.9 million per quarter in non-interest income, but also brought roughly $14.8 million in depreciation and amortization plus $11 million in other Verdant-related expenses per quarter, a net impact that investors should keep in mind when evaluating earnings. Axos delivers profitability metrics that are exceptional by any measure. In the second fiscal quarter ended December 31st, 2025, the company reported a return on average assets of 1.83% and a return on average equity of 17.44%. Both of these figures are well above the industry averages of roughly 1% and 10 to 12% respectively for community and mid-sized banks. Its net interest margin came in at 4.94%, roughly 150 to 200 basis points above the typical regional bank peer group. The efficiency ratio was 47.93%, meaning the company spends less than 48 cents to generate each dollar of revenue. The industry average efficiency ratio is closer to 60%, so Axos's lean digital model is a real structural advantage. Diluted GAAP earnings per share were $2.22 for the quarter, up 23.3% year over year. On an adjusted non-JP basis, which adds back acquisition-related costs and the Verdant provision, adjusted EPS was $2.25. Net income was $128.4 million. Net interest income grew 18.4% year over year to $331.7 million. Non-interest income surged 92% year over year to $53.4 million, largely due to the Verdant acquisition adding operating lease income. Axos has delivered impressive loan growth. Total net loans held for investment grew from approximately $20 billion at December 31st, 2024 to $24.8 billion at December 31st, 2025, an increase of $4.75 billion, or nearly 24% in just 12 months. In the most recent quarter alone, loans grew by $1.64 billion, or 7.1% on a linked quarter basis. The loan portfolio is well diversified across multiple categories. Commercial real estate specialty is the largest segment at $7.1 billion, representing 28.5% of the total. Commercial and industrial loans, including asset-based lending, cash flow lending, and capital call facilities, total $8.5 billion, or 34% of the portfolio. Single-family mortgage and warehouse lending represents $4.8 billion. Together, these categories reflect a strong commercial banking orientation. On the deposit side, total deposits reached $23.2 billion across 7 distinct funding channels. The largest is consumer direct at $11.3 billion. These are primarily high-yield savings accounts gathered through the Axos Bank digital platform. Commercial and treasury management deposits total $5.2 billion, and specialty deposits, including Chapter 7 bankruptcy trustee accounts, 1931 exchange firms, and HOA accounts, contribute another $3.4 billion. Approximately 85% of deposits are FDIC insured or collateralized. The Verdant acquisition also added equipment leasing assets to the balance sheet. Axos does not disclose specific future guidance, but the trajectory of loan and deposit growth is clearly strong and diversified. Axos operates with an asset-sensitive balance sheet, meaning that rising interest rates generally benefit the company. A significant portion of its loan portfolio consists of variable-rate commercial real estate, C&I, and capital call loans that reprice upward quickly when interest rates rise. The interest rate spread, the difference between the yield on earning assets and the cost of interest-bearing liabilities, was 4.17% in the second quarter of fiscal 2026, and the net interest margin expanded from 4.75% in the prior quarter to 4.94%. The primary interest rate risk lies on the deposit side. Approximately 48% of Axos's deposits are consumer direct accounts, which are high-yield savings accounts. These are rate sensitive. When rates fall, Axos can lower deposit costs, which would actually benefit margins. But if rates rise further and deposit competition intensifies, there could be some upward pressure on deposit costs. The bank has limited reliance on wholesale funding. FHLB advances are only $60 million, and there is no significant brokered deposit exposure. The available-for-sale securities portfolio is relatively small at approximately $811 million, which limits mark-to-market unrealized loss risk that has plagued some other banks in the rising rate environment. Overall, Axos's interest rate risk profile is manageable and tilted toward benefiting in a flat-to-higher rate environment. Credit quality at Axos is exceptionally strong. Net annualized charge-offs to average loans were just 4 basis points in the second quarter of fiscal 2026. That is near pristine and down from 10 basis points in the same quarter of the prior year. Non-accrual loans represented only 0.61% of total loans as of December 31st. Non-performing assets as a percentage of total assets stood at 0.56%, down from 0.71% just 6 months earlier. The Texas ratio, a measure of credit stress calculated as non-performing assets divided by tangible equity plus loan loss reserves, is estimated at approximately 5%. A Texas ratio above 100% is generally considered a warning sign for potential bank failure. Axos at 5% is well within a safe range. The allowance for credit losses stands at $327 million, or 1.33% of total loans held for investment. This reserve covers non-accrual loans by over 215%, a strong cushion. The provision for credit losses was $25 million in the second quarter, up from $17 million in the prior quarter, partly reflecting the Verdant acquisition's loan portfolio. The higher risk areas to monitor are the CRE specialty book at $7 billion and the ABL and cash flow lending at $4.4 billion. These segments could face pressure in a severe economic downturn, though current performance shows no signs of stress. Axos maintains solid capital ratios. Equity to total assets stands at 10.39%. At the bank level, Axos Bank's Common Equity Tier 1 capital ratio is 11.12%. The Tier 1 capital ratio is also 11.12%, and the total capital ratio is 12.37%. All ratios comfortably exceed regulatory well-capitalized thresholds of 6.5, 8, and 10% respectively. The company's Tier 1 leverage ratio at the bank is 9.15%. Book value per share is $51.70. Tangible book value per share, which adjusts for goodwill and other intangible assets of approximately $196 million, is $47.79 per share. On the liquidity side, approximately 85% of deposits are FDIC insured or collateralized, significantly reducing the risk of deposit runs. FHLB advances are minimal at only $60 million. The available-for-sale securities portfolio provides additional liquidity. Total borrowings, subordinated notes, and debentures were $365 million. Secured financings were $692 million. Axos Clearing LLC, the broker-dealer subsidiary, maintained net capital of $94 million against regulatory minimums, with excess capital of $88 million. Overall, the capital and liquidity position is sound. At the current price of $98.51 with 56.68 million shares outstanding, Axos carries a market capitalization of approximately $5.58 billion. Let us put this price in context with a few key valuation metrics. Price to book value is 1.91 times, based on book value of $51.70 per share. Price to tangible book is 2.06 times. Using the most recent quarterly diluted EPS of $2.22 annualized, giving us approximately $8.88, the trailing price to earnings ratio is approximately 11.1 times. The earnings yield is therefore approximately 9%, which is very attractive compared to current Treasury yields. How does this compare to fair value? High-performing banks with a return on equity above 15% and return on assets above 1.5%, which Axos clearly is, typically trade at 2 to 2.5 times book value and 12 to 16 times earnings. Applying a conservative 13 times multiple to annualized earnings of $8.88 gives an intrinsic value estimate of approximately $115 per share. Applying 2.2 times tangible book gives approximately $105 per share. This suggests the current price of $98.51 represents a 7 to 17% discount to estimated intrinsic value. Potential catalysts for re-rating include the completion of the Verdant integration, which should reduce one-time charges, continued loan growth, and potential Fed rate cuts, reducing deposit funding costs. Let us bring it all together. Axos Financial is a high-performing, digitally native bank holding company that stands out on virtually every profitability metric: a return on assets of 1.83%, a return on equity of over 17%, a net interest margin nearly 5%, and an efficiency ratio below 48%. These are best-in-class numbers that reflect the inherent advantages of a branchless, low-cost operating model. Growth is strong. Loans grew 24% in 12 months. Deposits are diversified across 7 channels, with a large proportion insured or collateralized. The company has a moderate interest rate risk profile with an asset-sensitive balance sheet that generally benefits in a higher rate environment. Credit quality is exceptional, with charge-offs at only 4 basis points, non-accrual loans below 1%, and a reserve coverage ratio of over 215%. Capital ratios are solid and well above regulatory minimums. Liquidity is supported by a high proportion of insured deposits and minimal wholesale funding. The primary risk factors to watch are the concentration in commercial real estate specialty loans, the ongoing integration of Verdant commercial capital, which is adding some one-time expense noise, and the rate sensitivity of its consumer deposit base. These are manageable risks in the context of the bank's overall financial strength. From a valuation standpoint, Axos appears modestly undervalued relative to its earnings power and balance sheet quality. At approximately 11 times earnings and 1.91 times book, investors are not paying a premium for what is a top decile performing bank. Our overall assessment is that the price is reasonable to attractive, with a fair value range of approximately $105 to $115 per share. That represents potential upside of 7 to 17% from current levels, with the additional benefit of a company that generates strong, recurring earnings.